Right. Hello, everybody. Today we will be covering an in-depth analysis of AUD ahead of the RBA meeting. There will be a couple of key things to consider. And I'm going to starting off by having a look at yields on AUD, USD, and Euro AUD. That's the two pairs I'm right now having a look at. In the morning session, we discovered that Euro AUD is headed lower right now, possibly could find these lows at 146.40, but ahead of RBA, there might be more to look at. So the first thing we're going to be looking at is AUD yield differentials between Australia and the US. And the other one we'll be having a look at is the yield differentials between Germany, which is a benchmark for Europe, against Australia as well. So we were looking at a 10-year yield just to really get a picture of what has been happening in that pair, why has it moved the way it has, and why it is where it is today. So one of the key movers for Australian dollar this year has been commodities. Higher commodity prices has drawn a lot of attention to AUD as one of the major commodity exporters. Most recently, we saw a little bit of a downside shift in AUD because of the slowing economy in China, which is probably one of the biggest importers of Australian commodities, but it is not that bad just yet. Again, having a quick look at the yield differentials, this is the Australian against the US, and if I were to compare this with AUD USD, it makes a lot of sense that why we've traded the way we have. Again, we use our yield spreads always as a leading indicator, not a lagging indicator to see where our currencies are moving. So AUD USD based on yield spreads is fairly priced right now. Yield spreads are not telling us there's another huge breakout coming. If anything, it's kind of rejecting the highs. But if you look at Euro AUD, let's see if there's a different picture. So this is Euro AUD and the yield spread. And it looks like this entire trend moving lower. Again, beautiful leading indicator, the yield spreads. And right now, the yield spreads are still sitting at these lows, which should be quite negative for Euro AUD as well. Again, no huge breakout is expected just now because yield spreads are still sitting quite tight. Now, ahead of central bank meetings, what I also look at is I look at the short-term yield differentials, the 2-year ones. So we're going to have another quick look at these as well and see if they give us anything new, any new information. So that's the German 2-year yield spread against the Australian 2-year yield spread, which is much more sensitive to interest rate moves. And ahead of central bank meetings, that's always a core thing you want to be looking at. And a lot of the times, it gives you a big head start to where the bigger trends are headed. For instance, here, you saw that yield spreads already tanked, but Euro AUD started to go up for another 200-300 pips until it eventually dropped now more than 1,500 pips, 1,500 pips. There's other times as well where maybe sometimes it was lagging or it was moving in tandem, and other times where it gives you a huge trend reversal, but Euro AUD might take its time until it emerges for that. So one of the occasions was around February and March last year. The yield spreads were firmly heading higher, but Euro AUD was still sitting lower, and eventually that resolved to the upside. Again, the better part of, so from the bottom of 153, it traded all the way to about 163 again, so about 1,000 pips. So yield spreads are always a huge trend setter, right? Sometimes the trend might kick in a bit later, which means there's a greater divergence, which means there's more pips to catch. It's just timing these things can sometimes get annoying. Again, in the short term here, the trend still seems to be intact, and short on Euro AUD makes a lot of sense to me as we are headed into the RBA meeting. More or less, I think there's going to be the same thing on the differentials between US 2-year yields and Australian 2-year yields. Let's have a quick look at that. And surprisingly, no, it's not. So Australian and 2-year against the US 2-year yields is telling us that Australian dollar could possibly come down very soon. Now, mind you that the correlation in the short term can a little bit get sketchy, but I think what this chart is telling us clearly that AUD/USD is trading frothy. So I'm going to be looking at that just now, because that's something that needs investigation. So looking at AUD/USD, we're setting it as 75 cents, setting at these highs. And the way that yield spread was looking, it says that we should be probably trading back to 73.72. So that is something I like to pay attention to as we are headed into the Tuesday meeting. So having a quick look at our Forex calendar here. Next week, Tuesday, there will be RBA meeting. Market is not expecting any rate hikes, but we maybe could see maybe some shift. That they're starting to become hawkish, and there are some banks also suggesting that now there could be rate hikes occurring in August and more in September. And here, Bloomberg article headline reads that market is wrong Australian rate outlook, and the pension giant says. And we're going to be looking at these articles when there's time. I still want to go a little bit through data. It's worth noting or taking note of why RBA will or could move. One of the main things they always said in the past meetings was that, let me go to the last release here. And for them to make any moves on rates, they want to see wage inflation, right? Let me see if we can find the latest statement, which was in March. And we're going to be, they're not very long, the statements are quite short. So I'm going to be quickly reading through that, and we're going to take note of the key language the RBA uses to guide markets. Central bankers love to talk sometimes in a secretive language, or they love to talk in mystical sometimes. So it's really prudent to go through every statement, the last 2 or 3 statements, to see what is the language they're using. I'm going to be pointing it out in these articles, and you can in the future, again, use them yourself. The latest statement was in March. We're going to be reading this together real quick, and we're going to be taking some notes on some key things they've said, and we'll be jotting them down here in my notepad. So last meeting was the 1st of March. We're going to take a note of that. March RBA meeting. And let's see the key things they talk about. It's meeting today, the board decided to maintain cash rate target 10 basis points, and interest exchange settlement balance is 0. The global economy continue to recover. Then we have a warning, major source of uncertainty. So see words like major, that is something you want to pay attention to. They use these sort of words to emphasize how they feel or think about something. So Ukraine war is a major source of uncertainty. And if you've been following the news recently, that uncertainty is becoming a bit more certain, isn't it? There's peace talks going on. Russia has pulled back from the attacks. So it looks like there's more certainty coming. But they certainly mentioned the Ukraine war as a major source of uncertainty, right? So that's a key word here, which I jotted down. Major uncertainty. Inflation in parts of the world has increased sharply due to large increase in energy prices, disruption to supply chains at a time of strong demand. The price of many commodities have increased further due to war in Ukraine. Bond yields have risen over the past month. Expectation of future policy interest have and expectations of future policy interest rates. So here, the RBA is acknowledging what is happening, and it's also acknowledging the bond market. The expectations for future policy interest rates have increased. So it will be interesting to see if they validate that, or if they negate that, or if they just don't talk about it anymore, which would be very interesting to me. The Australian economy remains resilient, spending and picking up following Omicron setback. Household and business balance sheet are generally in good shape, and upstream business investments on the way, and the pipeline of construction work to be completed. Macroeconomic policy setting remains supportive for growth. So macroeconomic policy settings remain supportive for growth. Good. The resilience of the economy is evident in the labor market, with unemployment rate at a 14-year low, 4.2%. Underemployment is also around lowest, and hours worked declined significantly in January due to Omicron outbreak, but the decline in infection rates and high numbers of job vacancy point to strong bounce back over the month ahead. The RBA Central forecast is the unemployment rate will fall to below 4% later in the year, and to remain 4% remain below 4% next year. Okay, wage growth was okay. I think this is one of the key things that they'll be looking at. Wages growth has picked up, but at the aggregate level. It's only around relative low rates prevailing before the pandemic. A further pickup in wages growth and broader measures of labor costs is expected as labor market tightens. This pickup is still expected to be only gradual, although there's uncertainty about the behavior of labor costs at historical low levels of unemployment. So here they're saying that wages are picking up, but at the aggregate level, they're not too worried about it yet. They're saying it's slow and it's steady, and based on their forecast, it's not going to go out of hand. Here they are hinting at inflation. They're saying, look, the real inflation, which once wages pick up because people have more money to spend, is not going to get that dramatic yet. Inflation has picked up more quickly. Here to follow up in the next article by talking about inflation. Inflation has picked up more quickly than the RBA had expected, but remains lower than in many other countries. Central forecasts for underlying inflation to increase further in the coming quarters to about 0.25% before declining to around 2.75% over 2023 as the supply side problems are resolved and consumption patterns normalize. The CPI inflation rate will spike higher than this due to higher petrol prices resulting from global developments. How long it takes to resolve the disruption of supply chains is an important source of uncertainty regarding the inflation outlook as developments of global energy markets. So here they're saying that the inflation is mostly caused by energy prices, and they're saying it's global developments. Basically, they're saying there's not a lot we can do, right? That's what they're trying to convey to the market. We know that so 2 or 3 things are standing out here. There's a major source of uncertainty around Ukraine. They are acknowledging that market is pricing interest rate increases. They're also saying that the inflation, that the real inflation coming from wage growth is gradual. They're not worried. And the other inflation that's caused by energy is more a global problem and probably nothing that our policy can, a policy shift will make any difference to. Financial condition in Australia continue to be highly accommodative. Interest rates remain at a very low level, although some fixed rates have risen recently. The Australian dollar exchange rate is around its lows of the past year or so. Housing prices have risen strongly, although the rate of increase has eased in some cities. Interest rates at historical low levels, it is important that lending standards are maintained, that borrowers have adequate buffers. The board committed to maintain highly supportive monetary conditions to achieve the objective of return of full employment in Australia and inflation consistent with targets. The board will not increase the cash rate until actual inflation, actual inflation sustainably within the 2 to 3% target range. While inflation has picked up, it is too early to conclude that it is sustainably within the target range. There are uncertainties about how persistent the pickup in inflation will be given recent development in the global energy market and ongoing supply side problems. At the same time, wage growth remains modest and is likely to be some time yet before growth in labor costs is at a rate consistent with inflation being sustainable at target. The board is prepared to be patient as it monitors how the various factors affecting inflation in Australia evolve. So there's a lot to unpack here. They are saying, for us, we look at inflation, we look at wages, right? So let's say CPI, they look at wages and they look at energy. And they also look at supply. So goods supply, basically. Some factories shut down because of, what's it called? The COVID pandemic. That meant that some goods, customers were receiving the goods later, and that caused inflation because there was shortage of some goods, yada, yada, yada. And they're making it very clear that wage growth in their central forecast is only going to be modest. So they're not worried that wage growth is going to cause inflation to skyrocket. They're saying energy is all over the place. It's unpredictable right now. And they want to wait it out to see where the median lies. And supply side, they're saying that the supply side pressures, although higher, they're about to come back down, which should ease the pressure on CPI. So that's the things they are looking at. But on the other side, they're also saying they will not increase on the rates until they see that inflation is moderately between 2 to 3%. over there within the 2 to 3% range. Actually, is sustainably in that range. So wage is okay for them. Wage will tick that box to raise rates because they say it's gradually increasing. Supply side, they're saying it's coming down, and once it comes down, in our central forecast, inflation should be around these levels for next year. So the only problem right now for them is energy, something they can't predict. That's why in the very beginning of the article, they said that the Ukraine war is a major source of uncertainty. So you can see that a lot of things are coming together for the RBA to move towards raising rates, right? So wage is ticked, that's good. Supply side in their central forecast is coming down anyway. Actually, if it doesn't come down, then inflation will still pick up. So in either way, this is this kind of ticks the box for them as well. And the only problem is energy prices. So as long as energy prices don't dramatically fall off a cliff and then drag inflation with it, their central forecast should come true. And if that central forecast comes true, they should be raising rates. Certainly, there's no reason for it to be 0.1% as it is now. It should go towards a quarter or maybe 0.5% as the year moves on. That's why you see a lot of banks making those comments to say that they think that RBA will raise rates because they can see all these things coming together. Again, that's a really long way of explaining a very short article, but I just want you to think a little bit in terms of what sort of language they use and what they're really trying to say to markets without saying too much. Don't know why they do it, they just love talking in myriads. So this was the statement from March. I said the statement what was in February. I think we're starting to see a bit of a picture there. Sometimes the press conferences after the meetings are quite important as well. So we've got the minutes. Let's have a look at the minutes from March as well. Unfortunately, the minutes are usually really long, so I feel a bit iffy maybe getting too much into this. This video will never end. And let's also have a look to see if there was a press conference in March. So in the March meeting, statement by Philip Lowe. At this meeting today, board included cash rate, reserve funds announced decision to one policy. Thursday, Australian dollars gained ground in the past weeks. Australian dollar remains elevated quarter on quarter due to income problem. Okay, nothing to chew on from the last meeting. What was I looking at? I was looking at the minutes. So this is the RBA minutes from the 1st of March meeting. The minutes always get published, I think, a couple of weeks after the meeting as well. And it's super long. Not very long, but it's quite long. So what I like to do is I like to see if I can see, if they made a reference, I just really want to scan really quickly to see if there's anything of note. When was this published? I would like to see that. And I can see maybe market reaction on the charts. That will tell me more. Let's see if I can see that here. And if I were to filter, and just want to see stuff related to the RBA, and I want to see when the minutes were published. That was on the 15th of March. So if you go back here to the charts and have a look at how market reacted on the 15th, and EURAUD absolutely tanked, isn't it? Giving us no entry, unfortunately. So on the 15th of March, I like to see how market reacted to the minutes. Let's maybe have a look at what happened on the 1st of March as well. So on the 1st of March, you had the RBA meeting, which was here, undecided candle. On the 15th of March, we had a little bit more detail, and you saw a nice reversal AD/USD. I think more or less the same was evident here Yeah, you had a nice reversal on the 15th of March in EURAUD. On the 1st of March, EURAUD was tanking already, but here we saw a nice reversal here, nice reversal here on the back of the RBA minutes. So the RBA minutes gave, I'm not going to go into the article, but very likely the RBA minutes gave market more confidence that there's an interest rate hike coming soon. And they're going to lay out the path of interest rate hikes very, very soon. If not in this coming up meeting next week, then maybe another one. Let's maybe have a quick look at this last, because it says consideration for monetary policy. Okay, so that was really pretty much copy paste from the statement. Okay, so we've got that. So we're pretty certain that things are moving in a direction where RBA will need to hike rates. Now there's this lovely website here, asx.com.au, which is very similar to what the Fed funds futures are. It's basically market pricing of interest rates increases or changes, right? I'm gonna leave in the chat and also in the link later, I'm gonna leave the, what's it called? I'm gonna leave the link here so you can have a look at it yourself later as well, everyone. But a quick rundown what this is. It's basically market pricing of how the RBA will, how the RBA is priced, right? So if I go back to the 23rd of March, market had a 64% of no change, then 58%, 50, 64, 74. On the 1st of April, it went up to 70%. The market is expecting no change from the RBA. That's the most immediate one. Really what you want to be looking at is the, I think it's the graph implied expectations. No, not that one. Rate indicator. Maybe it's this one. Oh no, I think it's the curve, isn't it, we're looking at? Bingo, that's the one I wanted to look at. So this is the, again, interbank cash rate futures implied yield curve. Long way of saying that's market pricing in interest rate moves by the RBA, or they're basically hedging it. This dotted blue line is the current interest rate of the RBA, right? They haven't raised it. As soon as they raise it, their line will move with it. You can see what the implied yield is by the market, right? So the interest rate right now is 0.1. Right now, as we are in the right now, the 1st of April, we are pricing it. Actually, market is pricing it under what it is currently, which is stupid. It doesn't make sense. Hence, you can see why AUD is probably appreciating to close that gap ahead of the Tuesday meeting. This will have to move back up to 0.1 to reflect what the current rate is. Now, for the May meeting, market is pricing in 4 points higher, 4 basis points higher from what the rates are. And for the June meeting, they're pricing a total of 18 basis points higher. For the July meeting, more. And as you can see, this drags all out. Depending what happens on the Tuesday meeting, all of this can change again because market will start repricing things. But as it stands now, they're pretty much looking for a full rate hike. Actually, they're expecting RBA to be by December, the interest rates to be at 1.7%. In my opinion, it's a little bit aggressive considering that the RBA hasn't even laid out the interest rate path yet. But once they start laying out the interest rate path, then we have some new information to analyze. But in the very, very short term, because for the April meeting, the implied yield is sitting lower than what the actual yield is, you can expect AUD to appreciate. And there is a better way of looking at this more real time. If you have a look at the Australian 2-year yield. That will give a little bit more of its giveaway. Again, here market, it's roughly pricing in what where yields will be by the end of the year. I think we just, did I close it? No, it's not. So it is sitting at, the 2-year yield is sitting at 1.875, and implied yields are here. No, it's actually pricing in what it will be for about next year, for January, February next year. So you can see how far the 2-year yield is tracking. So about a year's out. And as it moves higher and lower, you can expect that the AUD will move with it across the crosses. So that's something to consider. So we covered a lot of things. We covered how to read the statement. We covered how to read what market is pricing for the RBA. What we need to do now, we need to identify how far can market move and what's the best currency to trade it against. In my opinion, one of the best currencies to trade against is the AUD. The main reason is being that inflation is still high and we haven't seen the peak yet. Euro is one of the major importers of energy and commodities. Australia, one of the major exporters. It's very naturally you should expect Euro AUD to come lower. For today, I said that we are looking to see Euro AUD reach, oh, wrong chart. Today, I said we're looking for it to reach the 147.14 level. So we're maybe about 5-6 pips away from that, which we're very likely to hit now. Earlier when we discussed this, we were still trading up in these levels. No, a bit lower, isn't it? We were trading about 40, 30, I think about 30 pips, 40 pips higher. I think we needed to get a bit earlier onto this trade to make this work. Didn't really expect it to move this fast. I thought we were going to see a bit waffling about. But I don't think that will be the end for Euro AUD. I think ahead of Tuesday, we could see this lower level here, which is 46.39, which is roughly another 190 pips lower, about 100 to 90 pips lower for Monday, and Tuesday is very reasonable. Once the RBA has its meeting on Tuesday, a range of different things can happen. Maybe the RBA will be very hawkish. They give market a path for the rate hikes, and then we can take it from there. In my opinion, if RBA starts laying out the rate hike path, I don't think they will be as aggressive as market has been pricing. So you could see some disappointment in AUD on Tuesday. But it's nothing we can trade now. We're going to wait for our London fixes to trade those levels there. And let's have another look at another currency I know a lot of you love trading, which is GBP AUD, and more or less the same scenario. So I'm expecting for this to crack lower as well. So maybe have a look at the yield spreads before we finish this video. And the yield spreads, again, pointing lower. If I look at the short-term yield spreads, I think it's firmly, it's firmly in favor of GBP AUD lower. So there's not a lot to hold back these flows. But, you know, once you actually gather all this information, you look at it, it all makes sense now. Why Euro AUD is trading lower, why GBP AUD is trading lower, and why AUD is so strong is because we have all this information to suggest market is mispricing AUD strength, because there's a hawkish shift possibly coming from the RBA. Once the hawkish shift comes, you might see some profit taking, but then we can position for near trades after that. I have another, I'm going to have a quick look at the weekly for Euro AUD and GBP AUD. That always gives me a bit of a giveaway. Usually what you want to see is you want to see it moving negative. So GBP AUD already moved negative for the week, but I'm thinking there should have been room for Euro AUD to trade negative as well. I think there's a lot to ask for to do it today, but certainly it will be very encouraging to see this. I think, in my opinion, we're going to take out this weekly open. If not today, we're going to take it out on Monday or Tuesday. That's the direction I'm expected to trade. With AUD USD, it's a little bit trickier. If you've seen, the yield spread was a little bit pointing down, and we have this awful range now. It's just not some, you don't really want to diddle in the middle here. You really want to trade at the edges. So I'm going to step back a little bit from maybe trading AUD if I take any positions, it will be intraday, and it's something to do a bit more risk sentiment than anything else. I'm a bit more confident, barring any new information coming out of the Ukraine war, a bit more confident that we're going to see these levels getting taken out on EURAUD, and there's loads of incentive to trade in that direction as well. There's not a lot more to add. If you've got any questions, feel free to type them up in the chat, and I'll be able to answer them just now. In any other case, I'll be ending this video shortly. We're having a look at AUD NZD as well. And there is still firmly in an uptrend. AUD is certainly doing a lot of things right now. Okay, I think we've got a firm understanding of what we want to trade and how we want to trade it, what direction we certainly want to trade, and the reasons why you want to be short EURAUD in the near term until Monday or Tuesday, or until those levels are reached, which I pointed out. And there's not a lot more to add, but we're just waiting for the setups to make sure, or if you're already in the trade, then maybe even add to your positions to the downside. Okay, that's it. That's all. Thanks everybody for joining, and until next time.